Mathematical and Computational Finance Group. It's my pleasure to welcome you to the Frontiers in Quantitative Finance seminar. This is a monthly seminar brought to you by the Oxford Group, and which is sponsored by Cube, Citibank, and Mosaic Smart Data. Every month we have a talk by a leading quant or researcher from academia or industry who brings to you new developments in quantitative finance and risk management. And today it's our pleasure to have Roel Ooman as our speaker. Roel Ooman is head of R&D, head of quantitative R&D at Deutsche Bank for sales and trading. He has been working in the industry for many years in various functions related to FX. And he has also authored many studies and papers on the financial econometrics, especially high-frequency data, market microstructure, OTC markets, and today he's going to share with us a paper that he recently authored with Johannes Müller-Karbe from Imperial and Benjamin Weber on the hedging of fixing exposures in the foreign exchange market. This is one of the arcane aspects of foreign exchange that he will explain to you. Thank you, Roel.
Thank you very much, Rama, and thank you all for coming. It's a real pleasure to be here and nice to see some familiar faces. So yeah, this talk will be about the hedging of fixing exposure, and I'll spend probably 10 minutes giving you some context so you understand the relevance of this from a practical perspective. And then I'll talk through the model, and then there's about 5 extensions that we have on this model, and I'll probably cover 2 or 3 of those. If there are any questions, I'm not sure how we deal with that, but just feel free to ask me throughout if anything is unclear. Yeah, so for those of you not familiar with this, the FX fix, you can think about it as the sort of official close, the daily close of the FX market. The FX market is a 24-hour market, 5.5 days a week. But every hour or every half hour, there are benchmark calculation agents that look at the average rate of the spot, NDF, and forwards rates at determined points in the day and publish out those rates as benchmark fixing rates. And the WMR Reuters 4 p.m. fix, the London 4 p.m. fix, is by far the most widely used. So it's used by traders to hedge FX risk at that rate. Yeah, and so it's also used by hedge funds to backtest strategies if they don't look at necessarily high frequency data. But so it's a benchmark rate in the FX market. That's really what you need to know about it. It's published regularly, but the 4 p.m. fix London is the key one. It's had quite a lot of controversy, and here is an overview of all the fines that have been levied on banks that sum to about 10 billion for 2 reasons, really. One is claims around collusion, so people joining in chat rooms and sharing confidential information beyond what is appropriate. And the second point is around how the FX traders were actually hedging their FX exposure risk. So the collusion I'm not going to touch on, and that's the relatively straightforward part of this controversy. It's just simply wrong, and it was evidenced, and people were held accountable for that. The question of how to actually hedge the FX exposure is much less clear. And to give you a quote that I picked up at the time around of this controversy, this is from an FX trader in despair, let's say. He said, if I trade before the fix, it is front running. If I trade at the fix, it's ramping the fix. And if I trade after the fix, it is prop trading. And none of these three activities are allowed. And so he was asking how on earth am I supposed to hedge this FX exposure risk if I'm not allowed to trade before, at, or after the fix? Following these fines and investigations, there's been an industry reform led by IOSCO and the Financial Stability Board. And they have basically the industry has self-regulated itself by imposing standards around the fix. And the key points here is that it led to widening of the fixing window. So these calculation agents look at a local window and average the quote, but previously that was a 1 minute window, and it was thought that a 5 minute window is more appropriate, given that sometimes quite a large amount of flow goes through these fixes. And so a 5 minute window is less susceptible to manipulation or excessive impact. The creation of inter-dealer netting facilities. So there's a number of platforms that allow dealers before the fix to declare the interest in the fix and net that off before actually the fixing window starts. And then guidance around appropriate and transparent pricing, enhanced governance requirements. So what has happened in a lot of the banks, the fix was handled by the principal desk, but now it is handled by a segregated desk away from the principal business, and a number of other things. And given, I guess, the focus and the scrutiny on the industry, what a lot of the dealers have done is rather than hedging the FX exposure on a perhaps discretionary expert judgment basis, they have concentrated the hedging of these fixing exposures into a segregated unit where they tend to run a simple TWAP algorithm over the fixing window. And there's some academic literature on this that shows that following this reform, widening of the window, and dealers adopting a relatively, let's say, plain vanilla strategy around hedging of the fixing exposure, that the front loading of volume seen previously in the fixing window disappears, and any short-term reversals around the fix have also reduced. At the same time, though, they also note that they've seen an increase in HFT liquidity, opportunistic trading around the fix. And I'll actually, one of the extensions I'll close with is on that topic. Nevertheless, despite this industry reform, there is regulatory ambiguity that remains. And a good summary of the point here is by Kevin Rogers, who was one of the expert witnesses on the Mark Johnson trial. Mark Johnson was one of the HSBC traders that actually served prison time in the US for the way that he hedged the fixing exposure. But during this trial, the question was to the prosecutor, well, what should Mark Johnson have done differently in hedging the exposure? And this comes down to the question, should you hedge before, during, or after the fix? And on this, the prosecution had no coherent answer at all. At some point, the government, in fact, suggested that more sterling should have been bought before the fix. And so the expert witness is questioning, what did the government want more, front running or less? The further industry codes have been introduced, and they're summarized here, and they relate to the topic of pre-hedging, which is, there's a slight nuance here between hedging ahead of the fix and pre-hedging of, potential orders. But for the purpose of this presentation, I'm going to brush over this. At the end of the day, there's a conflict of interest that's important here, and these codes attempt to address that. So there's a number of industry codes on this topic, and they're emphasizing that if you're hedging ahead of the benchmark or ahead of an order, realizing the dealers should aim to minimize the market impact that they have on the market. They should do it for an amount that is reasonable relative to the anticipated trade size. So if you're asked, to hedge an order of, say, 500 million, you shouldn't pre-hedge or hedge more than that amount. And the pre-hedging or the hedging ahead of the benchmark should be designed to benefit the client. So there should be an assumption, or there should be a rationale behind why this hedging strategy is actually better than another hedging strategy, why it benefits the client in doing so. But lack of consensus remains. So there's an ESMA, two ESMA call for evidence, and the response from the industry is that there's still concerns around conflicts of interest, potentially abusive behavior. And IOSCO actually just last month launched another consultation citing potential concerns about the appropriateness of pre-hedging practices. So this has been a long-running debate in the industry. It's quite a polarized debate, I would say, as well, because there are certain participants that say any hedging ahead of the fix, any pre-hedging is essentially just front-running. And then there are people on the other side that say this is perfectly sensible risk management, and actually, if done properly, it benefits the client and enhances, or avoids potentially market destabilizing activity. And so it leaves us with the question, how should the dealer hedge or pre-hedge their large fixing exposure? If the fixing exposure is very small, it's kind of, you just run a TWAP or whatever you want to do over the fixing window. When the exposure is large, then the question is, should you still squeeze all that volume through the fixing window, or should you spread it out beyond that? And then the secondary question to that is what is the expected impact on client outcomes relating to that hedging strategy? And the answer in the industry discussions is, well, it's not that clear. So I asked my favorite LLM to do a literature review, and so I asked it, what is the most important paper on pre-hedging? And it came back with the theory of pre-hedging by Fisher-Black in 1986, published in the JFE. Has anyone read that one? It's a foundational piece of work. No. And I hadn't either, because it didn't exist. And so I told the LLM this, and it responded, haha, you got me there. It doesn't exist. So don't use ChatGPT or LLMs for your literature survey. There is some work related, not a lot. On pre-hedging, there's very little. On fixings, there is a decent amount of literature, and the literature that's closest, though not exactly related, or not the same certainly, is papers by the authors listed on the slides here that relate to the optimal liquidation of positions if your benchmark is, let's say, a VWAP. Now, the work that we do differs in a few ways compared to this work. So the first is, our focus is specifically on what is actually the outcome for the client rather than what is optimal for the dealer. So the industry debate and the regulatory focus is around making sure that whatever the dealer does is designed to benefit the client. That's not a question that's been addressed in those papers. We make the explicit distinction between hedging over the fixing window and prior to the fixing window, because it's kind of a binary distinction that is of great regulatory interest and relates to conduct in financial markets. And then we're interested in understanding how the dealer hedging strategy varies by the exposure size that they have, as we observe in practice that the hedging strategies vary by the exposure. And so to give you some illustration of the basic intuition, I guess, it's useful to go through this simple example. And so remember that we're looking at a dealer trading a TWAP. And let's assume for now that they trade the TWAP just over the fixing calculation window. So they have some exposure. Let's say they have to buy $1 billion at the fix. And so they're starting a TWAP algo that buys $1 billion in a straight line at a continuous rate, because the benchmark is calculated as the average rate. So they'll run a TWAP to basically match the way that the index is being calculated. And in this illustration, I assume there's only permanent impact. So when you run a TWAP, then the expected price move you're going to see is just a linear line with slope equal to the permanent impact, right, for the TWAP strategy. And in that case, the average hedging price for the dealer is going to be here. And that's also where the fixing price will settle, because it's calculated as the average rate over the window. And then, and now, alternatively, we can consider the case where the dealer actually hedged in the prefix window. So they're pre-hedging, loosely speaking. They'll achieve exactly the same average hedge price, but because the impact is permanent, it will stay up there over the fixing window. And now the fixing rate is higher due to the hedging in the prefix window compared to hedging over the fixing window.
But the prefix window can be long.
Sorry?
The prefix window can be chosen longer.
Well, the prefix window can be chosen longer. That's right.
So
yeah.
The slope is.
Yeah. So then, I mean, this is permanent impact only, so it's still going to be exactly the same impact. It will just be sort of accumulated over a longer period of time. And so in this simple illustration, and I agree there are many other variations, it's sort of a continuum of strategies you can consider, but in any case, in this illustration, prefix hedging is good for the dealer because this is the rate at which they hedge, but at the end, they'll exchange the risk at the fixing rate, which is higher, but it's bad for the client because they end up paying a higher fixing rate than they otherwise would. Now, if there's transient impact only, and we look at the same scenarios, the dealer is still trading a TWAP. Now, the impact profile with transient impact looks like this sort of concave shape. You're having impact, but the further you move the price away, it starts to pull back. It's a bit like stretching an elastic band, right? And so there's some inherent mean reversion, but you keep trading through the TWAP, so you get this implied expected price path. In this case, the average hedge price for the dealer is at this black point there, and then that's also where the fixing rate will be, calculated as the average price. But if now we go through the same, so now the dealer has pre-hedged in the same way, but now the market has time to revert, to let the temporary impact dissipate, and actually now the fixing rate ends up lower than it otherwise would have been had the dealer hedged over the fixing window. And so in this case, prefix hedging is bad for the dealer because this is their average hedging rate and the fix is over there, but it's good for the client. And so now to Rama's point, you can sort of be anywhere in between, and what we'll show is that basically you can find scenarios where prefix hedging is beneficial to both the client and the dealer, depending on the ratio of permanent and temporary impact and the decay rate of temporary or transient impact. But what you should get from here for now is that the people, this polarized industry debate where people say pre-hedging is always bad, that's sort of disproved by one of these examples. And people saying pre-hedging is always fine risk management practice is also disproved by this. So it's more nuanced than this. So the model that we're going to study is relatively simple. We have a dealer that has a net fixing exposure of X at time t of 0. And then the fixing, the price is going to be calculated over a forward-looking interval starting at t of p for a length of t of f. Yeah? So the dealer is at time 0. The prefix horizon is TP, and then the fix window width is TF. And I'm assuming here that the dealer can hedge with n equally sized trades, but they can determine the timing at which they place those orders in the market. And that's what they're optimizing over. And so this model allows for hedging over the prefix calculation window because you're allowed to start hedging at time is 0, which is prior to when the fix is starting. The only real assumption here is that you're only allowed to hedge in the direction that reduces your exposure. So I'm not allowing for sort of flipping of positions, but it is allowed to trade 2 trades simultaneously at the same point in time. So that allows you to sort of burst your hedge activity if that's perceived to be the optimal strategy. And then the hedging impact we assume incurs permanent and transitory impact, as in the Auberge-Wang model. And then the asset price that's unaffected by the dealer's hedging is a Brownian motion. So this is the whole model. The market price is basically the Brownian motion plus the permanent and transitory impact induced by the hedging trades, which are like n hedging trades of size x over n at times to be determined. The fixing price is simply calculated as the integral or the average of the observed market price, which includes impact of hedging, of course. And then the dealer's average hedge price is given by this one. The dealer's profit and loss is wherever the fixing price settles minus their average hedging costs times the exposure. And then the client's transaction costs, you can look at various metrics here, but here we're looking at arrival price metrics. So we look at the observed price at time 0. It's when they communicated the fixing order to the dealer. And whether they started hedging or not, nevertheless, that is the arrival price of the order against which the client is evaluating their costs. And then the dealer is optimizing an objective function that essentially maximizes risk-adjusted expected P&L. So expected P&L minus rho times the volatility of that P&L. Now I'm going to ask you a question, see if you have the answer. So if n is 1, so the dealer can only place 1 hedging trade for the full amount of their exposure, and they can choose to place that trade anywhere from 0 until the end of the fixing window. And their objective is just to maximize expected P&L. So they don't care about the risk adjustment. They just want to maximize P&L. Where would the dealer place the hedging trade? Any ideas?
0.
At 0? Okay. Somewhere else? Yeah?
Start of the fixing window?
Yeah. So at the start of the fixing window, now it depends, of course, a little bit on like, so 0 could be fine if there's just permanent impact only, but if there's also transitory impact, some of it is going to decay, and that means your fixing price is going to be lower than it otherwise would be, and the dealer's P&L is maximized at the highest possible fixing price. So you want to trade it right at the start of the window because the fixing price is the average price over the window. So if you were to start it somewhere in the middle, you're only moving it up in the middle, and so your average price is lower than if you had moved it up right at the beginning. If instead the dealer wants to minimize their P&L variance or their tracking error to the fix, then where would they place their single hedge trade? Any ideas? Sorry? Yeah, so in the middle of the fixing window. So you're just you can do 1 trade. You know that the fixing rate is going to be the average of the rate. And so like trading close to the middle there is minimizing the variance. Now and I won't go on for very long with this, but if n is 2, then where would they place the 2 trades if they want to maximize P&L? I'll just, because you won't probably guess this one. So there's 3 scenarios, and now it depends on the ratio of permanent and transitory impact. So either, depending on the parameter values of the model, you place both trades right at the start. Maybe you space them out within the window, and maybe you space them out in the prefix window, right? And that can be shown analytically within this model, that those three scenarios are kind of the optimal trades you would do if you maximize P&L. And the point here is that you can already see in this very simple model, just with two trades, you get optimal prefix hedging, you get optimal, say, ramping the fix right at the start of the window and trading optimally, spacing it out throughout the window. If you want to minimize the variance of P&L, then you basically just place them here. So it kind of equally spaced on these two parts. Well, over there. Yeah.
So here, these things will depend on the decay time, which is 1 over lambda in your relation, versus TF, the window width. So how do they compare this? So TF is 5 minutes.
Yeah.
The decay time, is it seconds, minutes?
Well, that's a good question. So so exactly here you can see the dependence. So you have these three regions. Those are the three cases for how you hedge with two trades, and it depends on the beta. So that's the decay rate of transitory impact times the length of the fixing window. So you can think of that as a fixing window normalized by the half-life of the temporary impact, and then the ratio of permanent over transitory impact. Now, in practice, the window is 5 minutes long for the most prominent fixing. There are challenger fixings that calculated now over a window of 20 minutes with unequal weights, but the vast majority of flow is executed over a 5-minute window. To your question of like, how quickly does the transitory impact decay in practice? That is an empirical question that's quite hard to answer. So there is literature that estimates the decay rate of transitory impact. We've looked at this as well. If I look just at public data, CME data, for instance, then I see a half-life of temporary transitory impact of about, say, 10 to 30 seconds. But the dealers are not necessarily hedging all this flow on the CME public markets. And so the liquidity pool in which they operate might actually have different transitory impact dynamics. Well, it might be quicker, it might be slower, it depends. Yeah. Okay. And then, so now we come back to the model. So if so this is, we're looking here, so we've parameterized the model. I won't show you the parameters here, but we choose them as reasonable as we could. And then we're looking at small fixed exposure, so x equals to 5. Yeah. And if the dealer can do one trade, then we optimize the objective function, and we find that that's where they will place their trade. So very similar to before, it's not exactly in the middle now, because they care about both expected P&L, but also the risk term. And so it's going to be somewhere between there, right? So it is there. Now, if they can do 2 trades, they're going to place them, so 2 trades of 2.5, right? So their total fixed exposure is 5. So they'll do 2 trades of 2.5. They'll place them over there. If they can do 3 trades of about 1.7, they're going to place them over there. If they can do 5 trades of 1, they'll place them over there, and so on, right? And so this is the optimal hedging strategy that's numerically optimized over the objective function just for optimal timestamps of their hedges. And they're given like this. And if you look at the cumulative position that the dealer acquires, it's basically just a straight line. So actually it sort of shows you numerically for small exposures, if the WMR fix is the benchmark, then your hedging strategy just aligns with that TWAP, with that average rate calculation. Now, if the exposure is large instead, so the dealer has 100, let's say, to hedge, if it can do one trade, it will, in this parameterization, it will traded right at the start of the fixing window.
It's small or large is relative to what? What's
Well,
the parameter in the model?
It's well, so it's X. So that.
What's the unit? It's in the model.
So in the model, I've parameterized all the models for this variable to be kind of 100 million. So 100 means 100 million, and then that is sort of calibrated, and then the units of the impact parameters, the horizon, the decay rate, it is all in equivalent terms.
When you write the impact, are you writing the size in average daily volume or something like that? Are you normalizing?
No. So I'm assuming here that basically the kappa and lambda parameters, let's say, are essentially the parameters that that are the impact observed if you trade 100 given some ADV or given some expected volume profile. Yeah, I'll continue. And then similarly, it can do 2 trades. It will be there. But now if we can place 3 trades, now you can see that actually the optimal strategy is to do the 2 trades here, but 1 in the prefix window. And if you can do 5 trades, it will do 2 of them, 2 out of 5 in the prefix window over there. And if you can do 10 trades and 25 trades, it will place them here, okay? And so now the optimal strategy you see for larger exposures is actually to utilize the prefix window. And if you look at the cumulative position that the dealer acquires, you can see it has this shape, yeah? And what we'll do next, I think in the next slide, if I'm not mistaken. Oh no, I have a bit more. We can also derive the continuous trading limit. So when n goes to infinity and you're starting to trade an infinite number of infinitesimally small orders, you go from 25 to, let's say, 100, and then to the continuous time limit. And we show that that actually coincides with what we can numerically solve for. Yeah. So the limit is well defined. So what this shows that in this fully flexible model with few constraints on the dealer, the optimal hedging strategy is as follows. Small exposure hedged with a TWAP over the window. Larger exposures are hedged in 3 phases, roughly. A TWAP, we saw it was relatively straight line in the prefix window. TWAP at a lower trading rate. Then a TWAP over the calculation at a higher trading rate. And a single large hedging trade at the start of the fixing window. So if you refer back to, If you refer back to this slide, you can see you're hedging more or less at a constant right here, a big burst of activity here, and then again, kind of a TWAP style trade after that.
So what is the threshold where you switch between?
It depends on the parameter values. But I think in this model, it's like around 20 or so. You start doing a bit of pre-hedging, and then the larger the order becomes, the more you do.
Is that because of the competition between the square root and the linear?
Yeah, so exactly. And so I kind of brushed over that, but the key to get the dependence on trade size here is that we have the volatility as a risk term rather than the variance. So if we had the variance in the risk term, then actually your hedging profile always looks the same, and you just scale it up by X, basically. But that doesn't quite capture the practice of what happens. And so to get that dependence on X, this discontinuity, if you like, in hedging strategy, that small orders are just hedged linearly over the fixing window, but larger orders are hedged differently. One way to get that is to have this square root term in the objective function, as Rama says. So now the next step we do is we do a simplification of this model, and we now just explicitly assume that rather than optimizing for these 25 or 100 timestamps of where to place the trades, we just say the dealer can choose 2 parameters. They will trade a TWAP in the fixing window, they'll trade a TWAP in the prefix window. They can decide how long their prefix window is, and they can decide the proportion of volume that they trade in the prefix versus the fixing window. So this simplifies the problem a lot. It is a slight simplification of the optimal solution, which is not completely exactly TWAP, but it's close enough, and it's certainly close to what people do in practice. So yeah, so on this slide, what you really need to know is that the dealer, instead of optimizing a timestamp, they only now optimize what's the proportion I do in the prefix window and how long should my prefix window be. And then you just run a TWAP at corresponding rates. And if you make that simplification, now your objective function simplifies a lot to the point where you can actually work out analytically what is the optimal proportion of flow to hedge in the prefix window, which is given there. The TCA, so the transaction cost, let's say, metric for the client, can also be expressed explicitly in this case. And so here I'm looking at what's the expected fixing rate given that there's no pre-hedging, yeah, versus the case what's the expected fixing rate that there is some pre-hedging. If this is positive, it means that pre-hedging benefits the client because the expected fixing rate is going to be lower than if the dealer had not pre-hedged. And so you can see that you have this equation, and I won't, like, it's all relatively straightforward stuff. And the point is that you can derive a condition from here that says the client will benefit if this condition is satisfied. And so you can see that this is a ratio of permanent over transitory impact should be smaller than this value. And these values, which I haven't shown you here, are simple functions of the fixing horizon, so the 5-minute or the 1-minute, 20-minute, and the beta, the decay of transient impact. And so it gives an explicit condition that says, actually, if the dealer adopts these TWAP strategies, then whether the client benefits or not doesn't anymore depend on the dealer's hedging strategy. It actually just depends on the market liquidity environment and is characterized by these equations. Yeah. Yeah. Which way does what go? Yeah. So your question is when the fixing window is tighter, let's say 1 minute, then what does the model say the pre-hedging should be? And it will say you do more pre-hedging the shorter the fixing window is, and you'll do less pre-hedging the wider the fixing window is. So this upper bound on the ratio of permanent over transitory impact is visualized there as a function of the normalized fixing window length and prefixing window length. And as long as you're below that, you know that the dealer's pre-hedging will benefit the client. And if you're above it, it's harmful to the client. So here I'll show you a short illustration of what happens here. So this is for a parameterization that satisfies that inequality. And so the model says pre-hedging should be beneficial to the trader. So look at this scenario. You have the dealer is only trading a TWAP over the fixing window. You see this impact. They do 10 trades or something here. They have permanent impact and it decays slightly from the transitory impact. But your average fixing rate is going to be here. Now, if let's say the dealer decides to do 50% in the prefix window, now their impact profile is going to look like this, and the fixing rate is here, the green line. So it's lower than the blue line. So you can see that in this scenario, the prefix hedging is benefiting the client. Now, what if they hedge just everything in the prefix window, more of it? Then the fixing rate is going to be even lower. Yeah. And
when you show this diagram, what is actually being displayed? Because You said the price has some volatility.
Yeah, so this is expected price path. So there's noise around this, but this is just the expected price path given the hedging strategy. So we're just looking at the impact profiles here, basically.
So there's no trend.
There's no, I'm assuming it's just a Brownian motion, no trend. It could be in there, but like, yeah, no. I mean, there's a trend over the fixing, of course, due to the persistent impact of the dealer over the fixing window. But there's no underlying trend independent of the hedging.
But if you have two dealers, then each one will see the other impact as a trend.
Yeah. So firstly, I should say is because of the reform in the industry, there are the netting facilities prefix, and so you would assume that any offsetting interest prior to the fix has already been netted out through these facilities before any trading starts. And so maybe a cheap way of answering your question is to say, I'm just looking at the aggregate representative dealer in this market that trades any imbalance across the market. The red line here shows if the dealer actually does 150%, so now they're over hedging in the prefix window, but you can see that it still benefits the client. Yeah. So actually any amount of pre-hedging, even more multiples of the actual exposure, benefits the client in this case. Now the dealer would never do it because their average hedging costs skyrockets here to like 19 when the fix settles at 13. So the dealer wouldn't do it, but if they were to do it, given these impact dynamics, it would be beneficial to the client. How much time do I have, by the way? We started a bit late, but I can.
15.
15, okay. I'll just, I'm gonna skip a few things, but so here, so far we've been, well, so there's a few different objectives you can give to the dealer. For instance, we could fix the pre-hedge horizon, and sometimes that's reasonable because, for instance, dealers tend to collect orders up to about 10 minutes prior to the fixing window, and then they say, we don't take fixing orders anymore, in which case your pre-fix window is essentially 10 minutes. But sometimes, for very large fixed exposures, the dealer is given a heads up by the client, or they agree a fixing transaction maybe hours before, in which case TP could actually be optimized by the dealer. So you can fix it or you can optimize for it. You can optimize the proportion that you want to hedge in the prefix window, but now you're optimizing your risk-adjusted P&L. Alternatively, you could say, the dealer, I'm actually going to optimize my hedging strategy to minimize the transaction cost for the client, subject to not making a risk-adjusted loss on my P&L. So you basically, essentially the dealer decides here, I'm essentially going to run it as a service. I'm not expecting to make any money from it. I'm going to optimize my hedging strategy to minimize the transaction cost for the dealer, for the client. And in all these different scenarios, you can look at cases where this hedging is beneficial to the client, irrespective of their transaction, irrespective of the objective function. So even when the dealer is sort of myopically optimizing for P&L, it also benefits the client. So it's a win-win. In this parameterization, actually you see that the some of the strategies lead to a very significant deterioration in client transaction costs, and in particular in this case. So you're optimizing the prefix window and the amount of prefix hedging you do. What the dealer decides is actually, I'm going to set my prefix window to 0, and I'm going to execute 70% of the flow at that. So that's mimicking that massive like ramp right at the start of the fixing window, basically. You execute 70% right at the start. and then 30% with a TWAP over the next 5 minutes, that leads to like a very substantial deterioration of client transaction cost. Yeah. So you see both sides. There can be big benefits. There can be big disadvantages to this from a client perspective. I'll skip this in the interest of time, and then I want to talk about a few extensions. So there are a few very trivial ones, let's say. So one is post-fixed hedging. So you can imagine that you can hedge in the pre-fixed window, you can hedge during the window, but you can also hedge some of it after the fixing window has expired. So that the model can be extended basically with a few additional parameters where you say, I have a proportion of this in the pre-fix, this in the during the fix, and that's in the post-fix window, and that has to add up to 1. And now, instead of a 2-stage TWAP, I run a 3-stage TWAP over those 3 regions. Yeah?
But if there's permanent impact,
yeah. Sorry?
If there's permanent impact, is that a good idea?
Yeah, it's not optimal for the dealer to do that if they just maximize P&L. Yeah. But if they also care about the tracking error, then having some of it before and after kind of symmetrically smoothed out their tracking error, but they sacrifice some P&L for it. But what you get now is, again, if the order is small, you do 100% in the window. If the order is large, you do half, about 45% in the pre, 14% in during, and 41% after. Yeah, so I won't go into that too much, but the model can be extended for these 3 stages. You can ask about time varying volatility and volume. So we can assume that there's volume and volatility profile in the market, and the model can be extended for that. I'll skip that. You can deal with nonlinear market impact, and it's quite robust to that, so I'll skip that. And then maybe I'll spend the last 10 minutes on the last 2 extensions, which is, one is, and there's sort of a separate spin-off paper on this, fixed calculation methodology. So I've spoken about the WMR, and it calculates the fixing rate over a 5-minute window. But there have been a lot of changes and a lot of innovation in this space, let's say. So we know that the window moved from 1 minute to 5 minutes. Then Bloomberg in 2016 introduced a B-fix, a challenger to WMR, and it was calculating it over 906 seconds and then 306 seconds. And then they moved it from 306 to 300 seconds, and then they shifted it 1 second earlier, the whole window. So there have been a lot of sort of changes to that over time, even quite recently. Walton introduced like the siren fix, which is an alternative fix that's calculated over a 20-minute horizon rather than the 5-minute horizon. And then with nonlinear weights, explained here by this green line. Yeah. So there's roughly like 3 different fixes. They vary by fixing window, and they vary by the weights within the window that are applied to calculate the average rate. And so what we did within the context of this model, we can look at all these different parameterizations of the model, if you like, and analyze what do these different methodologies mean for client costs, transaction costs for the client, and dealer P&L. Yeah, and the important thing to observe from these charts is that you see here are the 3 dashed lines. There are the 3 different methodologies for a 1-minute window, and then here are the 3 different methodologies for the 5-minute window, and here are the 3 different methodologies for the 20-minute window. And so you can see that the variation in this space, let's say, is primarily determined by the length of the fixing window rather than the weights that are applied within that fixing window. They seem to be clearly of secondary importance, both for client transaction costs and dealer P&L. The second thing to note is that this is basically the 1 minute fix, and this is expressed as a dealer Sharpe ratio for this parameterization. And you can see that even for moderately sized transactions, the Sharpe ratio of the dealers is just really good, right? And that was obviously reason for widening that window, and that depresses the dealer P&L because it can't move the market as much as it could for the same amount during a shorter window. And so the dealer P&L is depressed. But now if you go to the 20-minute window, it's depressed even further, but to a point where actually for small order sizes, their risk-adjusted P&L turns negative. And so if a client or a regulator would look at this, then they would quickly come to the conclusion, well, we should just widen the fixing window more and more, because that will benefit clients, lower transaction costs. Against that is the argument that if you extend it beyond some horizon or you push it too far, the risk for the dealers in hedging that exposure becomes too great, and they might actually withdraw from the market because there's just no expected risk-adjusted revenues in that flow, especially for small sizes. Yeah, so you need to balance like those two opposing arguments, I guess. The final extension I wanted to touch on is, and maybe to Rama's point, is like what if there's another participant in this market? So I mentioned in the beginning, it was observed in some of the academic literature that high-frequency trading funds are trading around this fix, and it's no surprise because the dealers are essentially trading with their hands tied behind their back, running very simple, predictable strategies. And for regulatory purposes, they can't be seen or can't be hedging in a way that's a little bit too clever, because they'll be accused of market manipulation or front-running clients or profiting from fixing flow. But of course, in that sort of constrained environment, the flow during the fix becomes predictable. And then the question is, what happens if you drop an opportunistic trader within that environment? And I'll only give you a very brief illustration, and this is still work in progress with Johannes and a PhD student in Zurich. But I'll show you some initial charts which give you the idea. So here's some random walk. It's the unaffected price, but the dealer is hedging with a TWAP, and so they have this impact profile over the fixing window, and then at the end of the fixing window, it decays. And so the observed price process in the market by the opportunistic trader is this gray solid line. Yeah, so it's sort of the unaffected price plus the impact from the dealer. And what the opportunistic trader can do is essentially run a Kalman filter, like Bayesian updating estimate of what the underlying dealer's fixed exposure is by observing the price impact that you have at the start of the fixing window. And this is one realization of this Kalman filter for one realization of a price path, and it will estimate the fixing exposure of the dealer at these values. Yeah, so it will fluctuate wildly in the beginning, and then it sort of settles on a value around 150, when the real exposure is 100. Yeah, but the opportunistic trader, that's their best estimate. And so in this case, when the trader is optimizing their P&L profile, the dealer is hedging 100 using a TWAP over the window. What the trader will do is get into a position up to around 20 million right at the start, and then trade out of it, and then it will do something at the end as well. But this is worth very little P&L. It's just because we have a risk-neutral trader that tries to squeeze every expected amount of money out of the market. But the real money is made in this part. And so the observed price to, let's say, a third party that looks at this, the accumulation of the dealer activity plus the opportunistic trader will be this black line is the observed price, and the trader plus dealer impact is going to be this blue line here. Yeah, and so here you can see that the impact is front loaded in the fixing window, and because the impact is front loaded in the fixing window and it persists over this window, it means that the fixing rate will end up higher than it otherwise would have been. So this is a simulation over 1,000 of those paths. And so now we're just looking at what's the average trader position. Well, it's this shape you've seen before, just smoother. And then we look at what is the impact observed with and without the opportunistic trader. And that's the green line versus the blue line. And so you can see when the dealer trades a TWAP, but there's an opportunistic trader in the market monitoring their activity and inferring what exposure is being hedged in a predictable manner, then the opportunistic trader can profit from that by trading right at the start, increasing the impact, and the fixed rate as a result is higher than it otherwise would have been. And so then the argument, another argument, I guess, for doing prefix hedging for the dealer is to essentially hide their flow more under the noise of the market, because the more they spread out their execution, the weaker the signal is for the opportunistic trader, and the less they can capitalize on that. And so the presence of HFT activity around the fix is another argument why dealers may be well advised to do some pre-fix hedging, especially for large order sizes. But again, all subject to the caveat that this all kind of depends on the underlying liquidity dynamics, because there are various scenarios where it is not beneficial. So I think that's where I'll leave it. This just sums up the presentation, really. Thank you.
The questions for the speaker?
When you speak of, Carlos, so when you speak of dealer P&L, you are just talking about the kind of leftover that is open for execution at the fix, right? Because dealers they receive orders for the fix on both sides, and only the net they take to the actual fix. And those orders that they receive at that net out, they contribute sometimes more importantly for the final P&L, and you're not accounting for that here, right?
No, I don't account for that. So if the dealer, so X should really be interpreted as just the net exposure that the dealer wants to hedge after they've netted in the interdealer market, after they've netted offsetting client orders that they've received. And then the residual is basically what they need to go to market with and hedge. And the offsetting trades, you're right that they make the commission, let's say, on both sides, and they don't even have to go to market or incur any hedging costs for trading those.
So in that argument of the regulator seeing, exodus of dealers, there's a bit more, there's another angle to that argument than just settling the outstanding net amount. And
yeah, so there's
more money on the table.
You're right.
Than
so
just that one.
So we're looking at here, the graphs I showed you as the risk-adjusted trading P&L of whatever they end up hedging. You're right that if in practice there's a huge amount of netting that all cancels out, then actually, even if they lose some money on the hedging of the residual, they've already made enough money on the commissions, on the netting flow. In practice, though, that's not a material amount. There's another point which I haven't mentioned, is that the commission for fixing flow has been steadily decreasing to almost zero. And in 2014 or so, the regulators had explicitly said to the industry, the banks and the clients, saying, we don't want to end up in this situation again, because we were in this situation because voice traders were basically taking fixing orders at mid, and then they were like, if I'm not making money on the spread, maybe I can make money in other ways for the bank. And that was through, perhaps inappropriate hedging practices over the fixing window. And so the regulator said, to avoid that conflict of interest, you can't do fixing business at, or you have to do it at commercially viable rates. And so when in 2014 or so, clients were charged probably like 2 orders of magnitude higher fees than they are today. And we're almost full circle now, where just through competition and pressure, the commissions for fixing orders are at an all-time low and very close to zero. So even if there is a lot of netting, it's not going to give a material revenue stream to the dealer.
Well, I have another question, if I may. Well, if you have put an extra participant, which is kind of an opponent, but even removing that one, if you have 3 or 4 dealers and they're all trying to do the same, well, if they are with offsetting positions, so they're actually not affecting the price that much.
Yeah.
But if, let's say, they are, well, prominently on one side,
yeah,
then there is a new game is going to set in, like a game theory problem is going to start to set in. Who moves first, and so on and so forth.
Yeah, that depends. So if the dealers actually had the flexibility to trade opportunistically over the fixing window, then you would get game theoretic interactions. But every dealer on the street is basically, as I said, sort of trading this with their hands tied behind their back using a TWAP algo. And so now you just have 4 TWAP algos, sort of running in the market, and they'll just find, oh, the market seems to move more today than it otherwise would. Well, it's because there are 3 other TWAP algos trading in the same direction during the same period of time. But the game theoretic interaction only comes if actually people have the flexibility to react to this, and they don't really.
Huh. Yeah, about the opportunistic trader, I'm curious about how the common filter is set up. Like, does it assume the underlying model for the scheduling of the trade?
Yeah. Well, no, it doesn't. It doesn't assume the scheduling of the trades, but it does make strong assumptions in the sense that the opportunistic trader actually knows all the parameters within the model. And in particular, it knows like what is the permanent impact, what's the transitory impact, what's the decay of transitory impact, and also what is the horizon over which the dealer trades. And that's probably a less strong assumption, especially if you only look at the case of hedging over the fixing window, then it's no assumption. But as we discussed in the beginning, like, nobody knows what kappa, lambda, and beta is in the market, right? And even if you believe that model, people would still have difficulty estimating those parameters. And that adds another layer of noise into your filtering process, which we're not looking at here. So this is kind of best case scenario. There's an argument though that like if these parameters are relatively stable over time, you've got years of data to estimate it, and now you just apply it to that window. But nevertheless, it's a strong assumption, I think.
Hi. So one of the constraints you imposed was that the trade size has to be equal for all trades.
Mm-hmm.
Do you have any idea how your model would look like if you would allow for differing trade sizes?
But it's not a strong assumption in the model, because I allow the timing of the trades to be the same. So it's essentially it's essentially allowing, the model allows for, even with n is 100, for all of these 100 trades to be executed at exactly the same timestamp. And so there, it's essentially not an assumption in the model.
Well, thank you very much, Roel. We can continue discussing with Roel over drinks. So thanks again.
Thank you.
So please join us and the speaker to